Let's fast forward and let's say you've already come to the conclusion that you want to put a long-term care insurance policy in place. Maybe you've seen a loved one go through a situation, whether it's a parent, grandparent, family member, maybe somebody that you know. So you know just how stressful and how taxing it can be. Yes, it's the financial toll that can be massive, anywhere from $10 to $20,000 a month, depending on where you live. But it's more or less the emotional toll that also comes into play, meaning that maybe it's a family member and you've seen who they were through the course of their life. Now they're relying on someone to take care of them, whether it's get out of bed, shower themselves, feed themselves, whatever it might be. So when something like this happens, what we tend to see is that usually clients who are in like their 40s, 50s, and even 60s will take a step back and start to think a little further about, how do I plan for the future if something like this were to happen to me? And so the question that we often get on our end is, all right, what are my options? How do I solve for long-term care? Well, my name is David Heller. I've been a financial advisor for the last 16 years, working with clients to help them not only build their wealth, but also help them figure out ways to protect it. And in today's video, I'm going to go over what your options are, because this is a common question. It's come up a couple times for me personally over the last 2 or 3 months with clients that I deal with. But it's important to understand that the long-term care insurance landscape has changed dramatically over the last 10 to 15 years. So in this video, I'm going to go over what's happening within the industry, what are your options, what are the things that you need to look for when possibly buying a policy for yourself. At the end of the day, there's really 2 main ways that you can solve for long-term care. The first is by buying a standalone policy, which is the original product that had been out in the marketplace. More recently, what we've seen is there's what's called hybrid policies, which is basically using permanent life insurance with long-term care benefits. So with all of that being said, let's get into it. Okay, let's start with the OG, the standalone policy. So often what you'll hear as referred to in the industry, if you're shopping for this, is standalone long-term care. This is exactly what the name sounds like. It's a policy that's going to give you long-term care benefits should you need it. There's no life insurance, there's no cash value. It is just pure insurance. It's probably you could almost look at it like being similar to term life insurance. And here's how it works. You pay an annual or monthly premium. In return, the policy gives you a monthly benefit amount. Let's use an example. Maybe it's $6,000 a month that you get. The benefit lasts for a set period of time, anywhere from 3 years, 4 years, 5 years, and maybe even 6. In most situations, there's also something called an inflation rider, which you can add onto the policy at an extra cost, but it will allow that monthly benefit that we were talking about before. So let's say $6,000. It will allow that monthly benefit to increase every single year that you have the policy. So maybe it starts out by $6,000, but it will increase by either 2%, 3%, or 4% every single year moving forward. So that pool of benefit that you have is greater. And so what actually triggers the monthly benefit to start paying out is if you need help with what's called 2 of the 6 activities of daily living, or ADLs. So that will be bathing, dressing, eating, going to the bathroom. And then you have something called continence, which is not being able to control your bladder movements, things like that. It will also get triggered if there's a severe cognitive impairment, say like early onset of Alzheimer's. So the benefit would get triggered if you had 2 of those 6 activities of daily living that were triggered, and that's basically how the monthly benefit would get paid out. Think of it like a pool of money that's sitting there and accumulating should you need to access it to pay for long-term care. So just like I was saying before, if you have that, it's pure insurance. So if you're funding the policy for a set amount of years and the values are accumulating in it, let's just say you don't even need to access the long-term care pool of benefits, or maybe you pass away, so you actually never needed to use the policy. There's no value in the policy, so you can't leave anything to a family member or someone that you care about. And in my opinion, where these policies become even less attractive are premiums aren't guaranteed. This is going to make more sense in a few minutes, but insurance carriers can raise the rates, and they've done that multiple times over the span of 20 to 25, 30 years. So maybe you're paying $2,000 for a policy back in 2005. It's very possible that you're paying $4,000 for that policy in 2020 or 2025. Also, you generally will pay for life for this policy. So it's every single year you're going to be paying the premium, or every single month, depending on how you have it set up. There really aren't any products that you can do short pay type structures. So that way you're completely done with paying for the policy. And like I said, it's a use it or lose it. So if you don't use the benefit, you can't get it back. Now, that doesn't mean that the policies are bad, but for advisors like myself and for our clients, it's no longer the go-to solution when trying to solve for long-term care coverage. In order to understand why standalone policies have significantly declined, it's important that we take a trip down memory lane. Over the last decade, the insurance carriers who offer these products have gotten hit significantly. The reason being is that when they created these products back 20, 25, 30 years ago, they completely mispriced them. They underestimated exactly how many people would need the coverage. There were other miscalculations that happened along the way as well, but basically they mispriced how they were pricing the product. The end result for clients, massive rate hikes, even for people that held the policies for many years. I'll give you a stat. Between 1990 and 2015, premiums more than doubled on average. By 2021, some saw a cumulative increase by over 100%. Genworth, which was a company that offered the standalone product, reported a 143% rate increase. Also, in 2000, the carriers that were offering long-term care insurance were about 100 or somewhere in that ballpark. Today, only anywhere from 6 to 10 insurance carriers now offer a standalone product. So as you can imagine, sales have significantly declined. Also, underwriting has become much harder. So this is just like life insurance in many examples where you have to go through some sort of underwriting to actually get the policy. It's estimated that either 1 in 3 or 1 in 5 who apply for a policy will get declined. And these are for people who are in their 50s and 60s from different information that I saw. And what's interesting is I go through a lot of these numbers and this type of detail. Being at my previous firm in 2014, 15, and 16, I can remember vividly having announcements in different meetings that we were having that certain carriers were either just exiting the business and or having rate hikes. So they wanted us to, reach out to people who had shown some interest in getting a policy or current policyholders that were going to see some sort of 20% increase, 30% increase, things like that. So now that we understand what standalone policies are, where the history has basically taken us to, let's talk now about what's become the go-to solution for advisors and our clients in the marketplace today. That solution that I'm referring to is what I referred to in the beginning of the video, which is called a hybrid policy. And so what this means is you're taking a permanent life insurance policy and you're adding on a rider for long-term care benefits, or what's called a chronic illness rider. I'll explain the difference in a few minutes. These policies are built on one of 3 life insurance chassis. So you have whole life insurance, you have variable universal life, and then you also have index universal life. I'm not going to go into the specifics of how these policies work and which one's better and this, that, and the other thing. As you know, some people love it, some people hate it. Again, this is not the video for that. This is just what your options are if you're looking for long-term care insurance in today's environment. And so as we reviewed in a previous video where I went through and explained how permanent life insurance works, let's go over it real quickly again. And I'm just going to talk very high level versus getting into the mechanics. If you remember, when you go out and you buy a permanent policy, you're going to fund it over a period of years. In return, the insurance carrier is going to give you a permanent death benefit that starts out at a specific number, and it's going to hypothetically grow every single year based off of the returns of the investments that you selected when you bought the policy. You're also going to be able to access cash value that's going to, again, hypothetically and presumably grow every single year. So what all these have in common is you're buying a life insurance policy, but when you add on the rider, it allows you to accelerate the death benefit to be able to use to cover long-term care expenses. Let's use an example. Let's say you have a $500,000 death benefit permanent life insurance policy. The structure doesn't matter. Again, whole, variable, index universal. If you qualify for care, carriers are going to allow you to accelerate your death benefit anywhere from 2 to 4% of that death benefit number per month. So if we look at this particular policy here, you'll see that it's a $500,000 death benefit. And when you do the math, that's going to be able to cover expenses for up to $10,000 per month, which would last 50 months. So that's just a little bit over 4 years. Now, this is how most carriers do it. There's some other ways that it can be calculated as well. Sometimes they'll allow you to accelerate up to 95% of the death benefit, but most policies are structured with that 2 to 4% ability to access that benefit. So in this example, you're not really buying a separate long-term care policy. You're actually leveraging your existing life insurance to pay for those long-term care expenses. There's also a waiting period involved. I think this is less of a talking point, but it is 90 days. So you have to be on claim for at least 90 days until the benefit can start to kick in. Benefit triggers are the same as before. If you qualify or you trigger 2 of the 6 activities of daily living, you'll start to be able to collect a benefit. Or if you have a severe cognitive impairment as well, you can start to receive a benefit as well. So now that we've gotten that out of the way, let's talk about 2 very important decisions you're going to have to make when you're designing a policy. And so that decision is, well, what kind of rider do I actually want? Because not all riders are created equal. Some policies come with a long-term care rider and some come with something called a chronic illness rider, and they operate differently. So the long-term care rider is actually what's considered to be true long-term care insurance coverage. It's part of this IRS code, which is 7702B, and it's designed to pay for care when you can't do 2 of the 6 activities of daily living, or again, if you have a severe cognitive impairment. But here's the key in how it differs from the chronic illness rider. In order to collect the benefit, it doesn't have to be a severe cognitive impairment. You can just qualify for 2 of the 6 activities of daily living. So let's just use this example. Let's just say you had a stroke and you needed care for 9 months for whatever reason, but then you recover. A policy with a long-term care rider would pay out. And so on the other hand, if you trigger the chronic illness rider, the condition must be certified as permanent and ongoing. That means that serious issues, while maybe not permanent, won't qualify. So the difference is this: that long-term care rider is really like equivalent to what a standalone policy is. It's going to cover you for if you need help with 2 of the 6 activities of daily living or severe cognitive impairment. The condition can be either temporary or permanent. You get a structured monthly benefit, for example, that 2% per month. And with the chronic illness rider, that condition's got to be permanent. It's also not going to pay in the same structure as the long-term care rider. It might give you lumpier payments. Some carriers don't offer any sort of like fixed benefit. They actually calculate it based off of a schedule, which is derived from your life expectancy. So it's good to have, but it's just going to be a little bit less flexible than, say, a true long-term care rider. So ultimately, what should you choose? It really comes down to what is it that you're looking for. If you're serious about long-term care planning and you want more predictable access to possible benefits, then a long-term care rider is usually a better fit. But if you just want some protections in place and have something that's there in case something real severe and permanent happens, then maybe a chronic illness rider can be something that is applicable to your situation. Just make sure that when you're going through the process, carefully examine, is this a true long-term care rider or is this the chronic illness rider? Because that difference can really change how you actually access the monthly benefit. Also, the long-term care rider is going to be a little bit more expensive, most likely, and require more underwriting than, say, a chronic illness rider. Chronic illness rider is usually included within the approval of a policy versus the long-term care rider, which you really need to go through some underwriting, and you can be declined or it could be approved. It really just depends. So while you're making that decision, do you want the true long-term care rider or is the chronic illness rider just as good for you as well? You're also going to have to decide, whether or not you want a reimbursement policy or what's called an indemnity policy. So this is how the benefits are ultimately paid out to you. So with a reimbursement policy, you submit receipts to the insurance carrier based off of the care that's been provided to you, and you'll get reimbursed on a monthly basis. Indemnity, on the other hand, is once you qualify, you just start receiving the benefit. You don't have to provide any specific proof every single month or submit receipts. So the reimbursement side of things, it's going to be a little bit more restrictive in terms of how you're actually paid the benefit. It's going to be a little bit more in terms of just admin, but it is going to be the majority of what you see offered in long-term care policies. Indemnity policies, they are growing as far as companies offering them. It's going to give you less admin that you're going to have to take care of, but you're going to have to be careful about how much benefit you're actually taking out of the policy so that you don't ultimately drain the policy. I kind of use an analogy: if you want simplicity and maybe a little bit of control, indemnity is the way to go. If you want to stretch benefits over time, then reimbursement is going to be a better option. So we've taken you through how these policies are structured and the two big decisions that you're going to have to make in terms of, are you going to get the long-term care rider or the chronic illness, or are you going to do the reimbursement policy or the indemnity? But some other just notes to be aware of. The good thing with permanent life insurance policies is you can structure them in a couple of different ways. So you don't necessarily, like in a standalone scenario, you don't have to pay for premiums for your entire life. You can do short pay policies, meaning you can fund it all up. You can fund it all at once, or maybe over a period of 10 years or 20 years, and then it's a fully paid up policy. It's also not a use it or lose it. There's going to be some value in these policies. So there's either going to be a death benefit that's paid out to the beneficiaries, or if you want to be able to use some of the cash value during your life, you can. And then you also have something for long-term care. So a lot of times people have referred to it in the industry as having like a three-legged approach as far as this particular strategy. And it's nice because the whole argument it's nice because of the fact that you know that if you have a long-term care policy, scratch that. And so it's nice because you know that if you do buy one of these policies, there's a very good chance that you're going to use it in some way, shape, or form, or that it's going to be there for family members at some point in time. Also, I won't go into specifics as far as like which carriers are best. Just know that for whole life products, they're going to give you more guarantees, not maybe as much growth. Some of the better carriers for that are going to be the mutual carriers, Mass Mutual, Guardian, New York Life, Northwestern. And then VULs and IULs are going to be better with companies like either Nationwide or Prudential or Lincoln or companies like that. Those kinds of structures do have more upside potential. They also have some downside protection, but also some downside risk as well. And so that's important because the benefit is based off of your death benefit at the end of the day. So you want to make sure that that's as high as possible in order to get the most amount of death benefit possible. Okay, so that wraps up the video for today. I'll probably come back and revisit this a little bit more in depth at some point because it is something that comes up in conversation quite a bit. And the industry has changed a lot. And so it's just important to understand all of these little parameters that you need to be aware of when you're going out and trying to figure out how to structure one of these policies. If you have any questions, feel free to reach out to us. There's a Calendly link where you can book some time with me if you want to discuss things a little bit further, or any financial questions you might have. If you like this video, please hit the like button. And to stay updated on future content, please subscribe. It helps our channel grow tremendously. And what we're trying to do is just bring good, solid guidance and advice and information to you in the public marketplace. With that being said, we'll see you in the next one. You're ready to take your financial planning to the next level with a customized approach? Feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.